John McDonald celebrates his 9th appearance on the All-America research team by capturing top honors for the first time in large-cap banks. The Sanford C. Bernstein and Company analyst discusses why the Federal Reserve's plan to end quantitative easing is a good thing for banks, but challenges still lie ahead.
The Federal Reserve's efforts to wind down QE3 and its overall quantitative easing program is a good development for banks. First, it indicates that the Fed has confidence in the improving U.S. economy, which is the number one most important driver for bank stocks. Second, it signals that higher interest rates are coming, which will also be good for banks' margins. On the other hand, the ECB's efforts to lower interest rates globally will make U.S. bonds more attractive, and investors start buying U.S. bonds. That'll make long rates go down, which is not good for banks. So there's a mixed bag there going on with the Fed pulling back its QE and the European Central Bank starting its own. The Federal Reserve is telling large banks, we want you to get simpler, we want you to get smaller. The regulators have a view that that will make the system safer for the next crisis. The impact of higher capital ratios on the banks will be likely to reduce their return on equity. That could have the effect of reducing the valuation of bank stocks. On the other hand, the bank's process of getting smaller could untrap some value to benefit shareholders, and shareholders might value bank stocks more highly if they view them as safer and more in favor with the regulators. We agree with the market's view that the Fed is likely to begin raising rates probably mid-2015. However, that's very data dependent. Even the Fed itself is not sure when it's going to raise rates. It really depends on how the data comes out over the next few months. Same thing in terms of the size and the aggressiveness of rate increases. That'll depend on how the data in the economy comes out over the next couple months. Bank stocks face a pretty difficult environment right now. The companies are having trouble growing revenues in an environment where interest rates are zero and loan demand is pretty tepid. On the other hand, credit quality is very good and fee income has been healthy for the banks. What would change our view is a pickup in loan demand and higher interest rates. That would make it easier for banks to grow revenues. The challenge of analyzing bank stocks in this environment is keeping up with all the changes in the regulatory environment and the big litigation charges that banks have faced. Those are difficult things to forecast, and predicting those is not in the usual analyst toolkit. The other aspect of analyzing banks that's difficult now is it's tough to differentiate when no one's borrowing and interest rates are zero. That makes it hard for the banks to distinguish themselves. It makes it difficult for us to distinguish between the stocks and differentiate among them.